Ads on TV all the time for those short-term payday advance type of loans. Well, they usually come with high interest rates and some various fees. And they are usually associated with those payday lending businesses that you see in the shopping plazas. But now even the big banks are getting into the short-term loan business, so we're going to talk about it. Financial guru Joe Bert joins us this morning for our Money Monday. Joe, always great to see you.
Morning, John.
Let's talk about these short-term loans. How exactly do they work that has a lot of people concerned?
Well, let's say on the first of the month you need $100 and you know, to buy an airline ticket or to get the kids' school supplies back to school, and you don't have the money. You haven't hit the payday yet. So here you are, the first of the month, you go in the payday loan office, and I'm going to borrow $100. But the deal is you have to write them a check for $120. So you give them a check for $120, but it's post-dated until your next payday, which is, let's say, the 15th of the month. So they're going to give you $100. You give them a check for $120. Come the 15th of the month, they're going to deposit that check for $120. So it costs you $20 to get that $100.
All right, that can be quite a bit of money. I know it's not always factored into the APR, but it adds up quick. So is it a good idea? Is it better to go to one of these banks, one of the short-term places? What are your thoughts here?
Well, let's do some quick calculations. You know, that $20, you know, people look at it, well, that's 20%. If I put it on my credit card, if I got a cash advance on my credit card, that might cost me 33%. So you see that this is only 20%, but that's a 33% APR. The equivalent on this $20 for 2 weeks is equivalent to almost 4,000% per year in interest. So it's not generally a good idea to borrow money that way unless you really need to.
Well, see, people don't do the math on that. 4,000%. You would never sign up for a credit card. You would never go to the bank and get a loan if it said, hey, by the way, we're going to charge you 4,000%.
No.
So what are some better options? Is it better just to do the credit card, I guess?
It's better off to do the credit card, but the key is, of course, you don't want to just start that spiral of borrowing and borrowing and borrowing. If you can put it on the credit card and pay it off in the same time frame as you pay off that payday loan, that's far better to do it. Or if you're fortunate enough to have a 401k at work, check into your 401k because oftentimes they'll allow you to borrow it. And if you borrow from your 401k, you're paying yourself back, and that's a lot better than paying a payday lender.
You know, a lot of states are cracking down on these, calling them predatory loan practices. What do you think about the future of these? Now that the big banks are getting in, I'm sure that dynamic's going to change.
Well, I think you'll have some pushback from the consumer groups are looking at this, and of course it all gets down to every state has their own legislature and legislation that has to be passed, and you've got both sides pulling because it's great money, it's great return on your money, but it's also very, very bad for the consumer.
Put people in a tough position.
Yep, sure does.
All right, Joe, Certified Financial Group, always great to see you. We will talk to you soon. Amy?
All right, John.